Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. We also have with us today Corby McGordon, who's my business partner at Ennis Legacy Partners. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or what we call sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that is transferable and then exit successfully on your own terms and conditions. Walter, no matter what exit route we're helping an owner plan for, sale to a third party, sale to co-owner, insiders, transfer to a family member, sale to an ESOP, bankability is almost always a key driver for a successful transaction. Bankability referring to a business having sufficient profit, assets, and liquidity to qualify for bank financing.
Yeah, that's definitely true, Pat. And I kind of look at that two ways. One is if a company isn't bankable, and if it's for one of the reasons you mentioned, specifically like sufficient profit or liquidity or assets, I mean, that's also going to be a valuation issue and really just an issue of whether or not the business is even ready to sell. So that's one way I look at it is if a business isn't bankable, then there's some financial issues there for sure. But the other way to look at it is, a lot of the deals we do are transfers to insiders, key management group, things like that. And in virtually all those situations, there has to be a loan involved because the people who are receiving the business, they don't have the cash to buy it outright. So it's critical in that situation, especially that the business is bankable because there's going to have to be a loan on the business in order to secure the seller. Even with a sale to a third party, I mean, they could very well need to borrow against the value of the company. So it's really important, and I think it's a great topic to discuss today.
Yeah, so that's right. So to have the greatest number of exit options for exit, it's good to know now, well before you're ready to exit, if your business is bankable or not, because of what the scenarios you just outlined there.
Yeah.
Our topic today: what makes a small business bankable? And our guest is our friend Afreen Husain from M&T Bank. She's VP, Senior Relationship Manager in Business Banking, and responsible for managing comprehensive banking relationships with companies having revenues up to 35 million. She manages a portfolio of business banking clients here in Maryland and in the District of Columbia. She joined M&T in 2009, has over 20 years of banking experience. So we got a real knowledgeable, experienced professional here with us today. She's a member of the Association of Builders and Contractors of Maryland, achieved a Bachelor of Arts degree from the University of Bhopal in India. And we know from experience working with Afreen that she has absolutely a passion for helping business owners grow their business. And her personal mission is to help you, the owner, make the most of your time and money, which is always a good thing and a very welcome thing. So we're excited to have our friend Afreen with us today. Afreen, welcome to the podcast.
Thank you. Thank you for letting me join your group. This is amazing. It's all about partnerships.
That's right. That's right. And you're really good about that, Afreen. So Walter, I think you have our first question today.
Yeah. Hey, Afreen, great to see you. And I'll start off by saying, as a CPA, I cringe when I get an email from a client saying, hey, we're getting a bank loan, or we have to, re-up our bank loan, because I know I'm going to get a million questions from the banker. I got to send a million forms. And in most cases, they're going to ask questions that don't make sense. But I will say from personal experience dealing with M&T Bank, that really is not the case. So I really appreciate what you guys do over there. You do a fantastic job with our business clients. But let me start with a question. So, Pat gave his definition of bankability, which I think was a good one. Do you kind of agree with that? Is there anything you would add to that description, or did he kind of cover it when he hit on profits, assets, and liquidity?
Absolutely, I agree to that. But most banks, especially M&T Bank, also look for like a couple of other items. So we believe in 5 C's of credit. That includes cash flow, which is of course the liquidity of the business, and sometimes the owners as well, because we do global cash flow calculation using their income and net worth. The second thing is collateral, whether they have collateral or not. And then in most cases, when they're exiting the business, the collateral is the key. And most of the businesses have tangible or intangible net worth. So to come up with a collateral gap or collateral shortfall, we are preferred as be a lender. So we go to that. The third thing is the credit, of course, the credit of not only the company, how the company has been performing, but the owners, their credit also is very important, who will continue, or the borrowers who are seeking to purchase that company, their credit is important as well. Capital, again, capital, what capital are they going to bring to the table as a down payment, like equity? Their own personal owner's equity is important as well in transactions like that. And the last thing is character. What's their experience look like? We normally look at their resumes and their experiences in the similar field if they're purchasing a company, or the owner who is, one of the two owners is exiting and the one who's continuing, we look at their experience. So character is very important in these aspects. So 5 C's of credit, I explained: cash flow, collateral, capital, credit, and character.
That's great. That makes a lot of sense. It's interesting, when you talk about capital, because a lot of our clients are closely held businesses, and they tend to be pretty thinly capitalized. They didn't put much money in to start the business, and they pretty much are taking out everything they earn. But I think especially as you get near a transaction, that's a really good point. One factor I think business owners need to look at is maybe not drawing out so much and starting to build up a little bit of capital, because it's going to make the transaction probably go a little bit smoother. Let me ask you a specific question that it's kind of timely, in that we all have clients who very strong businesses and we're cruising along doing great, and then of course COVID hit. So now hopefully they're starting to come out on the other side, but when they show up in your office and they want a bank loan, they may have a year that looks really horrible. What's M&T doing about that?
So we did update our credit memos when we submit a deal related to COVID, the pandemic hit, and how the businesses were affected by it. We're still lending. We're still looking at the financials, and so we're also asking for projections at this time, because the 2020 year was not good for everyone. So what are the customers, what are the borrowers, or the business owners are doing in order to come out of what they have suffered in 2020? So what's their 2021 looks like? We're paying closer attention to that. And also we're asking for projections when they're in the process of coming out of it, what their projections look like in terms of not only the revenues, but how they're managing their expenses, which is very important. Are they using their capital wisely? Are they going to achieve their goals or not? So those are very basic questions that we're asking at this time related to COVID and the pandemic that affected their businesses. So a lot has changed. So a lot is depending on what they're doing now and what they're going to be doing in the future. So is their business plan and projections are accurate? Are they going to hire a team, or are they going to work within the team, within their business team to make those goals achievable? So I know a lot of businesses are hurting and suffering, but by this time, they have figured out a way how to come out of it and how to manage their expenses and preserve their capital. They learned a lot with this pandemic. So these are the additional items that we've added to our credit submission forms.
Yeah, that makes sense. And hey, Corby, I know the work you do with clients is heavily geared towards budgeting, cash flow management. I mean, that's perfect for what Afreen's talking about, but you and I both see it when you go into a new client, how few businesses actually have that information or even the ability to generate it.
Yeah, I think in many ways it it seems to be mysterious for a business owner. They're not sure how to do it. But, you know, it's like planning a trip. Well, you figure out where you want to go and what's reasonable to get there, and it's better than nothing. And along the same lines, Afreen, you mentioned use of capital and wise use of capital. And we all know that, like, small growing businesses in particular consume cash, and it's always a challenge. How do you look at that? How they're using capital? Are they using it wisely? What criteria do you look for to validate that this is a smart person that's growing it well, even though, you know, their net may be a little thin?
Yeah, there are several indicators on their financials that we look at it closely, like how they're managing it wisely. For example, lines of credit. If the lines of credit are used and evergreen and they're not making an effort to pay it down, that's like a key factor in our world to make sure that they are using, once the income started coming in, they're paying the lines down as well and using it wisely. So there are several factors like this that are involved. That is just one example I just gave you on that. So yes, using it wisely, we're taking a closer look at it. And then, like I said in the beginning, we're a preferred SBA lender. So if there's cash flow issues and collateral shortfall, we always tend to get SBA guarantees on that. We just want to help them. We just want them to come back to and then grow their business and help them out.
Yeah, and then along the lines of the growth, for you, what constitutes that's a good growth plan as opposed to not so credible? What do you look for there?
For a good growth plan, basically it's their write-ups. And then the question that we ask wisely. Every business is different, so everyone needs are different. So we ask questions related to their needs and then how they're executing their business plan. And then we just want to make sure that they are minimizing their expenses as well. Like, there are several expenses that don't need to be there, whether they're paying attention, whether they're paying close attention to it, and then avoiding those expenses. So we don't want them to use the capital and then use all the funding and then come back to square one. I know there are small businesses, they can still minimize their risk and minimize their expenses going forward.
So you're saying a business plan is not supposed to sit on a shelf and collect dust, but actually be a living document?
Exactly. They need to execute on it. Absolutely. And we like to see that. And it reflects in their number when they grow their business.
Very good. Very good. And then just simply financial controls, right?
Exactly.
Yeah. Very good.
So, Afreen, you know, one of the key messages, if you listen to this podcast for any period of time, you're going to hear us say what we're about to say, what I'm about to say right now. Plan well in advance. Start planning today if you want to exit your business successfully, and if you want to grow it in the right way so that you can, and so that you can have multiple options to exit. You know, what kind of advice would you give to a business owner who they may not need a bank loan now for long-term growth or acquisition or for exiting, but they foresee that in the next 3 to 5 to 10 years? What kind of advice would you give them that they could start to execute on now that would increase their chances that Afreen's going to say, yep, okay, we'll give you the money that you need to buy out your partner or whatever it is? What advice would you give them?
So our advice to all of our business customers to look at their operating model, how they're executing it, and whether that operating model is working for them. Most of the time, they're used to their existing operating model and they don't like changes. But we ask them and we advise them to talk to their CPA, to talk to their attorneys, and also their entire team to make sure that their profit margins are increasing day by day. It takes, when anyone who decides to exit the business or sell the business in the future, it definitely takes 2 to 5 years for them to make the business profitable. And then a lot of times when the business valuations comes in, customers are shocked that, oh my, this is what not I was expecting. So when they talk to experts and then execute their plan and execute on their profitability model, that's what banks would prefer and advise them, to show profits and increase profits. Of course, we love to work with businesses and business owners who are expanding their relationship with us and who are also on the growth phase. Sometimes we start with very small, like startup companies, and now like 3-4 years down the road, they blow up their numbers. They triple in their sizes of not only the capital, but also the profitabilities. So those are the businesses that we work very closely with, and then we partner with different advisors, and then of course sometimes they do have their own as well. So we ask them to go back to them and then work as a team with all these partners to make sure that they are on the growth phase and that they want to end up where they want to be. So because sometimes it comes out as a shocker when a customer comes to me like, I'm ready to retire in 2 years. I was like, did you even talk to any experts? Did you even get the company valuation done? And then they have no clue about that. So at that point, we suggest them to talk to experts, and then want to make sure that you want to sell the company, which you're expecting that it's worth this much. So yeah, our advisors are always through different partners that we suggest them to go meet with them, and then also they're ready to accept our advice anytime. Most of them they do, but some of them like no plans at all. Those are the ones who comes out with a shop and give them the advice.
I have a question for both Walter and Afreen. Just that concept of valuation versus bankability. They're different.
Yes.
Could you comment on that and just kind of clarify what the difference might be?
So valuation is basically what the overall company looks like. So whether it's tangible or intangible assets, everything that a valuation company would look at it. And then they also use the cash flow as well. But that doesn't make the company bankable, basically. So in those situations, we help them advise them to go to various partners. Like for example, exit planning strategists or CPAs or attorneys to help them put together a plan, like an exit plan or a strategy, how and what they should be doing in order to exit their business. So this is basically like two different things, which, like I said, it gives a shocker sometimes to customers that the value is this much, but you're still not lending me that much money. How come? Right. So yeah, they're two different things. Absolutely. Walter, you want to help with that?
No, I think you covered it perfectly. But let me ask you a question that I will often tell clients. You know, even if let's say they don't have any debt on their books at all, I'll often say to them, look, you should go to your bank and open up a line of credit. Even if you don't necessarily need it, it's good to have it just in case. Is there a downside to that advice, or would you agree with that, or what's your thinking on that?
Yeah, that's a good question. We often encourage new clients who don't have any bank debt, and they're proud of that. They're proud of the fact that they don't have any debt. Well, and we'll say, well, yeah, that's good. But at the same time, when you go to want to grow through acquisition, or you want to go, if you want to exit and you need a bank loan for that, it's going to help you at that point if you've proven that you're bankable before and have been faithful to pay the money back. So that's a great question. Thanks for bringing that up, Walter.
We do the same. As you advise, we advise the same. The company is bankable and doing fantastic. Some customers are very conservative. They don't want to see or show any debt on their balance sheet. But lines of credit is a perfect way to set up an emergency lines for working capital needs, just in case. Who knew the pandemic would happen? And then in those situations, if those customers who had a line of credit available, they should have been using it to overcome some of the cash flow differences. So yeah, we also recommend the same thing. When you don't need a line, that's the time you should go ask for a line of credit. And then they will definitely get approved. But when they are in need and they're desperate, it's that the time they're going to get a little pushback. So yeah, because we base it off of company historicals as well. A lot of banks do that. They look at the company historical performances, and the line of credit amounts are mostly based off of the historical performances, whether it's accounts receivable or the revenue that they're generating. So we also do the same recommendation: open up a line of credit just for emergency needs. If they don't use it, they don't have to make any payments on it. So it just sits there for emergency needs.
Yeah.
Yeah, and absolutely build history for the business as well, that the business borrowed money and how many times they used it. It helps the business scores, just like on the personal side, helps the scores when you have borrowed money and then paid on time, etc.
Yeah. So, Afreen, let me ask you a final question. I mean, when you look at a business, are there any factors that we haven't discussed that kind of jump out at you or that are important to M&T when they're reviewing a loan application or reviewing a banking relationship?
Well, mostly it depends on whether it's a startup or whether it's a mature company or whether they're in the middle of it and they're in their growth phase. It all depends on that. But we love to bank with companies who are growing in an expansion mode because they keep bringing business to the bank, basically. So, and then we advise them as well, and then along with their other partners to continue to grow the company. Everyone, when the customer builds their company from scratch, it's their baby basically, and then they want to grow it. Some has slow growth plans, some has, like, for example, government contractors and IT companies, the growth plans are like double, triple every year or so. So everyone's different, everyone's need is different. But yeah, we love to work with companies who are on their growth and expansion mode, and we love to help them.
Great. Thanks again for joining us. I think this has been really, really helpful. Let me ask you two questions to wrap up. One is, how can our listeners contact you, and is there anything you would like to promote today?
They can contact me at any of my email or cell phone number, which of course it's on my bio over there. M&T Bank is helpful in, we call ourselves a relationship bank. So we all are personal bankers to our clients, small business owners. We don't give them our 800 number because I don't even remember what 800 number M&T has. We always give our direct lines or our cell phone numbers, and we work very closely with our customers. Promoting M&T Bank is a relationship bank. We not only look at one side of their business, but we cover every aspect of, not only on the business side, but personal side as well. And then we help them grow their business, and we want them to be successful. And that's where the relationship comes in. We help them connect with like-kind people and other partners to make sure that they're getting full service from M&T Bank. And I promote myself as a personal relationship banker, which works very closely with the clients and then help with all their needs, whether it's on the business side or on the personal side as well.
Yeah. So why don't you mention your direct phone number and your email address?
Sure. My direct line is 240-620-2638. And my email is ahusain2@mtb.com. It's AHUSAIN2@mtb.com.
That's great. Thanks again, Afreen. We really enjoyed having you on our podcast today. And
Thank you.
listeners, if you need help in maximizing the value of your business or planning for your eventual exit, you can reach Pat at 301-859-0860. You can reach me at 301-951-9090. You can also access resources at exitreadiness.com, grfcpa.com, and nslp.com. As always, thanks for listening. And until next time on the Exit Readiness Podcast, this is Walter Dial and Pat Ennis signing off.